Hey investors, welcome all of you to StockSpot, your go-to episode to unpack what's happening around various stocks, industry and economy. And before we begin, here is a quick disclaimer. Any stocks or trends mentioned in this podcast are purely meant for informational purpose. So be clear that they are not investment advice of any kind. So having said this, let's get started with the outlook of chemical industry for FY26. The domestic chemical industry is expected to be healthy, backed by economic growth and increased government spending. On export side, though some signs of pickup is seen in the second half of FY25, the global landscape is expected to remain challenging. In the case of China's domestic demand, though it will see some improvement led by its government's stimulus measures, the improvement is expected to be slow and gradual. The reason why this matters to us is because if there is a low demand in China, then the product manufactured in surplus levels will find its way to global markets, leading to a pricing pressure on Indian exporters. The same is the case with tariffs as well. Though the US tariff on China opens up opportunities to Indian exporters, due to the very same tariff, the goods from China which would have gone to US otherwise will be now redirected to other countries including India, which is again a headache for domestic players. To talk about inventories, throughout 2024, the global chemical inventories stood at a higher levels, keeping prices under pressure. However, the prolonged destocking resulting in inventory reduction will drive up the demand to refill the inventory by second or third quarter of FY26. Now coming to chemical prices, though oversupply from China and softer global demand continue to weigh on prices, the chemical prices are expected to bottom out by this financial year, and it is also expected to sequentially improve thereafter. Next, the margins of the company operating in this sector is expected to improve 100 to 200 basis points, driven by the combination of reduced inventory losses and operational efficiencies. Thus, after witnessing a down cycle condition over the last 1 year, the Indian chemical sector is expected to see a gradual recovery in FY26. So having said this, now it's time to dive into the quarterly performance of Prince Piping Systems, one of India's largest piping solution provider and multi-polymer manufacturer. In the third quarter of FY25, the company's revenue was adversely impacted by weak demand, which further led to decline in volume and increased carrying cost of inventories, thereby affecting the overall profitability of the company. Also, during the quarter, the lower PVC prices in the open market led dealers to refrain from increasing their inventory levels due to the expectation of further reduction in prices. Now looking ahead, the company expects the medium-term demand to remain healthy. It is implementing a wide range of multi-channel marketing strategies, brand reinforcement and customer loyalty initiatives to achieve growth. Also, the company says that its new manufacturing facility at Bihar will go on stream from the first quarter of FY26 and will cater to the rising demand in East India, which is a fast growing market in the country. Now let's move on to Ashok Leyland, one of India's leading commercial vehicle manufacturer and the market leader in bus segment. In Q3 of FY25, the company registered an 8.14% growth in revenue and 38% growth in profit after tax, and it continues to hold over 30% market share in domestic medium and heavy commercial vehicle segment. The company's export volume for the quarter increased 33% year-on-year. Now looking ahead, the significant sequential improvement seen in Q3 compared to Q2 is expected to improve further in Q4. The company focused on profitable growth through product premiumization, cost leadership, better service reach, and enhanced value-added services. It is also continuing to invest in electric battery and alternate fuel products to maintain its technology leadership position. Now looking on exports, the sales momentum in international market is expected to accelerate with the launch of new products. In short, the company remains optimistic about the growth of CV industry in the medium and long term as the macroeconomic factors continue to be favorable. And now let's show the final spotlight on Alicon Castalloy Limited, one of India's leading manufacturer of aluminium castings. In Q3 of this financial year, in the backdrop of weak demand, weak consumer sentiment, and caution due to uncertainty around tariffs and regulations, The top-line growth of the company was impacted by softer demand in key export markets such as Europe and North America, followed by weakness in certain segments like EVs and commercial vehicles and production shutdowns at customer facilities. Though improved demand in domestic two-wheeler market partially offset the impact, the profitability and margins were affected due to unfavorable product mix as the higher margin volumes from EV and CV are declined. Despite these near-term challenges, the company continues to take strategic measures to mitigate cost pressures and optimize their operations to ensure more balanced portfolio across vehicle segments and regions. Looking ahead, the company believes that they are nearing the bottom of this slowdown in the global industrial cycle and is focused to tap on the industry's long-term growth potential. So that's it for today's episode of StockSpot. If you find this episode insightful, make sure you follow and share this with your friends. So until I meet you in the next one, it's me, LEKSHMAN MJ, signing off.